So if you've been paying attention to the news this side of the year, you would have known that there's been a lot going on in the markets. We've seen quite a few market dips and rebounds over the course of the first couple of months in January, and this is because of tariff wars as Trump has kind of kicked off in his second term as US president. If you recall, in 2024, we spoke about the possibility of having a Trump 2.0. And at that point, I was speaking to the research director at XTB, Kathleen Brooks, and I'm happy to say that Kathleen joined us again for this episode to talk about what the outlook for the global markets are, considering the fact that we now have Trump in office, and indeed he has kicked off with some tariff wars. So welcome back to the show, Kathleen.
Thanks so much, Peter, and thanks for having me.
So obviously, Trump is now back in office. I'm really interested to kind of get your views as the director at XTB around what this means for the markets in 2025. I mean, could we see that the ongoing tariff wars will have an impact on the markets over the long term, or are we just in this spat where there's a lot of uncertainty and we've just got to wait things for things to simmer down a little bit?
I think it's really interesting. And there's been a real line in the sand compared to how the markets reacted in the lead up to the election last year and after Trump got elected, and how they've reacted since his inauguration in January. So we had all this euphoria in the build up to him taking office in January. So, we had that rally in November and December, stock markets reaching record highs, lots of optimism, especially in the small and mid cap space as well. And then that has really just totally drained away. I feel like, a lot of us in the market, they bought it. Particularly for small cap stocks, we sat there and we thought, deregulation, cutting taxes, this is going to be great news for the market. We knew tariffs were on the horizon, but I think we thought that he would take a similar approach to what he did in the first term of his office. And it turns out he really didn't. He's gone much harder. He has gone broad based in his tariffs, and that has just drained sentiment. That draining of sentiment means that over the last month, we've seen a 7% decline for the S&P 500, and the Nasdaq 100 is in a technical correction because it's down more than 10%. So I think the sharpness of the sell-off, the brutality of the sell-off has been a bit of a shock to many.
Mm. There are also now fears emerging of the US economy going into recession. What are your views and your take on what your feelings are about that at XTV?
Yeah, I think that, last year was all about inflation, or the last few years were all about inflation. And I think 2025, we're totally focused on growth, even though there will be an inflationary aspect to the Trump tariffs and a potential trade war. But essentially, recession fears have absolutely surged in the US. So they're now hovering around 35%. They were pretty negligible at the end of last year. So this has been a massive sea change for markets. Anything with that R word, the recession word, is a bit like kryptonite for stock markets. And what I think has really been shocking to the market is that the stocks that were the most highly valued in recent years, those key tech stocks, that magnificent seven in the US, they're the ones that seem to have been really kicked hardest on the back of these growth fears. So Tesla is down, more than 40% year to date. We've seen big declines for Nvidia. It's been so volatile. The rest of the Magnificent Seven are barely being able to hold on to any gains this year, and they really are under pressure. So not only are small caps falling, but they're also falling alongside those big caps. So the fears of a recession in the US are really leading to a reassessment and a recalibration of how people are thinking about US stocks. And they're certainly not as exceptional now as they were just a few months ago.
It's interesting you say that because people often quote the S&P 500 as kind of like one of the most popular indexes to invest in. And when you look at the S&P 500, the Magnificent Seven have been responsible for a large proportion of the performance in that index over the past few years. And with the tech sector taking a bit of a hit now, how does the S&P 500 keep up with the maybe expected level of performance that people have been experiencing over the last, few years without the Magnificent Seven being that huge contribution factor?
Well, the bar is a lot higher, Peter, essentially. And it's more in line with what's going on in Europe and with what's in the UK. Now, it's really hard to say that, we need to expect the S&P 500 to, it's unlikely at this stage that it's going to be able to reach those highs, those 20% plus gains that it's made in recent years. I think that's probably that was a unique experience, and that was way above average returns for the S&P 500. So in some ways, we're just returning to a bit of normality, but that bump down to normality is shaky, and it's going to have some twists and turns, and maybe the US will underperform this year. It's certainly underperforming. It looks like it will underperform in the first quarter, especially relative to Europe, but also to Asia as well. Because part of what we're seeing is a rotation out of US stocks elsewhere because the US had become so concentrated in the tech sector, but also global stocks. The MSCI Global Market Index was 70% US. Now there's a reassessment going on, which is leading to people ditching some of their US exposure and moving into Europe, moving into Asia. China stocks are becoming a bit more palatable for some investors as well. That's really magnifying the impact. So any bad economic news we get from the US is massively magnified because people are using that as an excuse to sell out of the US and maybe buy more elsewhere. There are some really compelling themes elsewhere as well. We've got the European defense theme, which I'm sure we'll speak about later. But the I think what's going on in the US right now is a really hard recalibration, reevaluation. Regionally, investors are shifting their preferences a bit. Now that's taking a real toll on the US. That will settle down. I don't doubt that will settle down, but I think we've got to look at what happened 2023 and 2024 as an outlier for the US, and that the US is normalizing, but it's going to be a hard process.
It's really interesting you mentioned the move away from that reevaluation of how much of a portfolio goes to the US now, with a diversification into Europe and the rest of the world, because I think, generally speaking, the US has been the major market for the longest time. And over the past few years, I would definitely argue that there's been a sentiment that the US is really the place to go. It's taken, I guess, when I look at the people that I speak to on a daily basis who follow investment content, they're very heavily invested in the US. And when we talk about diversification, taking that global view, what you've just mentioned there is the reason why global diversification is so important, is so that you're not relying on one single region for your returns and you're taking a broad-based approach.
I agree. I also do think that, the US is still really, really important. It's still the world's largest economy. It's going through some big changes at the moment, political, economic as well. And that's obviously got to be reflected and priced into the markets. A lot more uncertainty is being priced in at the moment. So even if you do hold a lot of US stocks, of course you do, because they're some of the biggest companies in the world. We all do in some ways. That doesn't mean that, the US is dead and buried and gone, and we should always, ditch all our holdings in US stocks. Absolutely not. That would be the worst thing to do. What I think investors need to get a bit more used to, though, is there's a normalization. The last 2 years, we all got lulled into this false sense of security that the US was really exceptional on the growth front, that it was, powering ahead, nothing could stop it. Its AI theme wouldn't come up against anything. Well, that's not the case. Earlier this year, in January, actually, when the Magnificent Seven started to come under pressure, it's not just Trump's tariffs that are doing it. It's also what happened with DeepSeek. So that's the Chinese AI company that is able to run AI models in a much cheaper and leaner way than it seems like some US companies are doing, and on less advanced chips. Now, all these chips for AI models, they're essentially all made by NVIDIA. So even Chinese firms need to buy NVIDIA chips, but maybe not at the pace and that they have been. And then could some of the other companies in the world, some of the US companies, could they actually learn from China? Because we were so focused on China's growth and the weak aspects of China's growth, we lost track of the fact that it was actually really building down and embedding its AI capabilities, but it was doing that in maybe a cheaper, more cost effective way than we've been used to. That absolutely roiled US markets. That's when it kind of started. And it just hasn't stopped since then. So it's really having a crisis of confidence. That doesn't mean that we need to get rid of the US at all. They're still really, really important. I mean, go to any supermarket and you'll see American brands are stocked in every single supermarket pretty much in the world. Coca-Cola, for instance, lots of other food companies, lots of those kind of staples. So it's just about, maybe thinking about the US differently. It's not just about tech anymore. Tech is coming up against challenges. Of course, it will do. If you zoom out, it's done incredibly well over the last 5 years. It's just the last, 3, 4 months that it's really struggled.
Yeah. On the on the tariff front, just going back to that, obviously the tariffs on Canada have been met with counter tariffs, and American products being taken off the shelves of Canadian supermarkets. There are a number of theories around why he's doing it and how he's going about doing it as a negotiation tactic. But if it persists, how much of an impact are retaliatory tariffs likely to have on the US economy as a whole? And then how does that then interact with the US market for investors?
Yeah. I mean, look, that's all hypothetical at the moment because we just don't know and we have to wait for the economic data to come in. But we are starting to get some assessments and forecasts of about what some big institutional bodies think it will do. So we got the OECD forecast for their updated forecast for growth this year. What's interesting is that they still think the US will be one of the fastest growing out of the G7 economies. Um, However, the pace of growth has really slowed. Likewise, Canada's growth has been slashed in half. We've seen Mexico's growth. Mexico's now expected to enter a recession. It wasn't in December when the OECD last released their forecasts. We're going to hear from the Fed and we're going to hear from more and more big institutions, and we're going to get that real economic data in. So at the moment, we can say that sentiment is absolutely at rock bottom in the US, both investor sentiment, but also consumer sentiment as well. Inflation expectations are rocketing. They're at the highest levels in the US since 2021. That was right at that peak of inflation, just as inflation was really kicking off. Anecdotally, we're hearing stories of, the price of eggs in the US. This has become a really big theme that, regular dozen eggs is $9. So I think that, the impact of tariffs are definitely starting to show through in these forecasts. That's knocking sentiment to an extent, but the bigger issue is around the real economic data, and that's going to take a few months to come in. Now, in terms of when you mentioned, Peter, about, how long will they have to be there, it does seem like Trump is shifting from using tariffs as a negotiating tactic to actually, just slamming them down and saying, no, we are going to do these because he's desperate to cut taxes, but the argument goes that he needs to get all of this tax income from tariffs to be able to justify the tax cuts. So they've But then it's no longer a negotiating tactic. It seems like he's very, forceful with them. The reciprocal tariffs, which are meant to come into play on the 2nd of April, he said they definitely will. We know that they're very, very complicated, and reports recently suggest that the US, the teams that are going to be implementing these, are looking at a much more simpler way of putting in place those reciprocal tariffs. How that will manifest itself, we still haven't heard. So there's still this risk of tariffs hanging over financial markets, and I think that's really going to limit how far the dollar and US stocks can rally and recover in the short term.
Yeah, that's really interesting. There were so many conspiracy theories and suggestions of what he's doing and why he's doing it, and they're all very interesting. But I'm kind of like, we don't know for sure. So it's like you say, it's a lot of speculation at this point in time. So what you pay attention to, please be mindful of what you pay attention to. Here's a question for you. In terms of opportunities for 2025 on the global stage, what opportunities do you see at XTB?
I see Europe, Europe finally making its comeback. I mean, just look at the gains that we've seen in the DAX, in the Euro stocks so far this year. Europe has got some great companies, and because the focus has been on the US for so long, we've almost forgotten about them. It's got its own thing going on. So it's got a big luxury sector. It's got a great pharma sector. It's also got a great, defense sector, as that's really coming alive at the moment. We're looking at Germany unlocking spending and disbanding with its debt rules, which have been such a hindrance for the German economy for so long. They're actually saying that they're going to look towards Europe, maybe even the UK, in that, while they boost their spending for defense and also for infrastructure. That's a huge amount of money, and that could really put Europe on the front foot. I also think the UK is worth looking at. They kind of turned into a de facto diplomatic leader. I thought what was really interesting is, they are trying to form a bridge between the US and Europe. Whether or not that will work, I think time will only tell. That's going to be a very difficult exercise in any case. But I think what it's doing is pushing the UK back towards Europe. There's now talk about customs unions, about how Europe and the UK need to band together in the wake of Brexit because of Trump's tariff threats. That really opens the door to to the UK once again. We're also seeing, well, if it not only are the tariff threats have many impacts on global trade, but maybe also we need to look at our energy security as well. So, that could boost our domestic energy companies in the UK, which are mostly hydrocarbon based. They've certainly the likes of BP, they've been hindered for a while, but they could potentially take off as well. If Europe looks at becoming, a bit of a self-sufficient group along with the UK, I think for too long the world has really looked at the US. The other place, of course, that's doing really well is China. And we're seeing opportunities in China, particularly in their tech space. Now, it's hard for some investors to get access to Chinese tech companies, but there is the Golden Dragon Index of US listed tech firms. That's been massively outperforming the NASDAQ, and its outperformance is at the widest for more than a year. So some really, really interesting opportunities out there. We've been so used to looking at the US as having the center of everything. But look at Europe. It's got some great companies, and don't dismiss them. They could just go from strength to strength in the next couple of years.
That's really insightful and really, really good to kind of hear your views there, especially from a professional point of view. Because oftentimes, yes, on YouTube, there's a lot of opinions, but I know that everything you just spoken about there is from a very researched perspective from the information that you get at XTB. And that also governs what you do for customers at XTB as well.
Yes, absolutely it does. And we're constantly looking at the data, we're constantly looking at charts, we're looking at fundamental analysis and economic data. We don't just pluck our ideas out of thin air, as you said, Peter. And I think diversification is key. For too long, a lot of people were really worried that they weren't having enough exposure to the US. Well, now, as I said, don't ditch the US. It's still really, really important part of the global economy. The economy is still expected to grow well, even if it is expected to slow down, maybe even dip into negative territory. But we've got all of these great global companies in Europe. If they can, pivot away from the US, maybe look towards building other stronger trade links with Asia, with elsewhere, to be honest, the tariff threats from Trump really give these companies an opportunity. We've been talking about in the UK anyway about building our links with China, trade links with India, trade links with other economies. This is the perfect opportunity to do it because they'll want to do it as well. So we can't don't waste the crisis. Um, the other, there it is an uncertain world though. We can't forget that. There's a lot of geopolitical tension that's still going on. And obviously we've got this economic upending by President Trump's unorthodox economic policies. But that's opening up the opportunity for gold as well. We've seen gold rally to $3,000. We haven't necessarily seen the gold miners play catch up. Remember, there's quite a lot of gold miners, particularly in the FTSE 100. This could be their type of sign now that gold is really solidifying and cementing its position above $3,000 per ounce.
Yeah, that's really interesting. Here's a last question for you on this episode specifically. You spoke a little bit about how, Britain, China, there's this need now, almost a necessity for us to be able to open up relationships with other countries, other economies. And it feels like that's a broad-based thing. It's not just us. Canada looking to do the same thing. Could that represent a risk of decline in America's supremacy and how they're perceived on the global stage from like just a geopolitical point of view?
I mean, yes, I think that's a big risk. Having America first is in a global world doesn't quite chime right for a lot of countries, for a lot of a lot of world leaders, but also down to the man on the street and also business owners. Everyone thought, well, America was at the forefront of globalization. What's going on now? And then obviously, what you're seeing is a lot of American CEOs having to scrabble and build relationships with Trump and promise this, that, and the other. Look, America is still really, really important for the global economy, and you're seeing that. We've seen a number of companies, car companies. We've seen TSMC in Taiwan as well, the chip maker, pledge to spend billions and invest billions in the US. So they are, in some ways, listening to what Trump is saying and acting on that. That's going to have some impact on capex spend, but it's a huge ask to try and get become the US to become a manufacturing powerhouse. I mean, in just he's only going to be in pound for the next 4 years. So we'll have to watch that one out, I think.
Yeah, interesting. Okay, that was the last question in this one. I mean, I think if you're watching this and you've been paying attention to the markets, I hope that some of this has been useful in just in terms of you getting your head around what's the direction of travel for the markets. Obviously, we don't have a crystal ball, right? But a lot of the time, it is about trying to make an educated guess and understanding what's going on around you, so that informs your investment decisions as a whole. I still take the position that, ultimately, if you're investing for the long term, this is just something that happens as part of the course. As an investor, you got to be prepared for that in some way, shape, or form. I'm going to continue speaking to Kathleen in a moment. We're going to put this into a part two. We're going to look at more of a global market update and look at what's happening around the world. Are there any particular regions that she thinks might have an opportunity to really outshine and outpace as an opportunity for potential investors? But before we finish this episode, XTB at the moment is ISA season. So if you haven't used your full ISA allowance this year, or you have not contributed to your ISA this year, your stocks and shares ISA, they have a really great offer on, which gives you a boost on the money that you can earn in your uninvested funds, up to 6.5% for 90 days. There are T's and C's that apply. I will leave a link to it down in the section down below. They also have their investment plans as well, which is really just a simple way for you to set up, invest, set on autopilot, forget it. It's a really, really great offer for the uninvested funds. Believe me, it's pretty top notch at the moment. From my research looking at the market, it's very, very competitive. So make sure that you check them out. And I'll see you in part two. I'll come back with Kathleen to talk a little bit about more of a global overview of where we think things might head by the end of 2025.